Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see, step by step, whether it really deserves a spot in a serious dividend portfolio. Today we're examining General Dynamics, ticker GD, a global leader in defense, aerospace, and mission-critical systems present across combat systems, marine platforms, secure communications, and business aviation through Gulfstream. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the Max Dividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if GD is attractively priced today. How this company makes money. First question, do I clearly understand how General Dynamics earns its money? And does that business model make sense for dividend investing? General Dynamics generates revenue by designing, manufacturing, and supporting defense and aerospace platforms, and delivering mission-critical technology used by the US government, allied nations, and select commercial customers. Cash flow is driven by long program life cycles, recurring sustainment and modernization work, and the long service life of platforms that require ongoing upgrades, not by consumer trends or short product cycles. The core earnings drivers are aerospace, Gulfstream business jets and aftermarket services, including maintenance, repairs, and parts, with demand supported by corporate travel needs, fleet replacement cycles, and recurring revenue well beyond the initial delivery. Marine systems, nuclear-powered submarines and surface combatants supported over multi-year programs, anchored in long timelines, high barriers to entry, and sustained modernization needs, with revenue visibility extending far beyond a typical industrial cycle. Combat systems, land vehicles, weapon systems, and munitions-related capabilities for the US Army and allied customers, with installed fleets and ongoing sustainment providing repeat business over time. Mission systems and technology integration, secure communications, command and control, sensors, and IT modernization that must meet strict reliability and security standards, strengthening customer relationships and supporting long-duration contracts. In other words, General Dynamics is not a black box. It's a scaled defense and aerospace contractor built around multi-year programs, recurring support work, and mission-critical systems that tend to stay funded through a wide range of economic environments. Exactly the kind of structure that can support a long dividend record when paired with conservative financial management. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple, at least 15 years of consistent dividend growth. General Dynamics doesn't just clear that bar, it shows the classic stair-step dividend pattern long-term investors want, in a business shaped more by multi-year programs and funding priorities than by short-term consumer demand. Annual dividend per share climbed from roughly $1.80 in the early 2010s to about $5.90 most recently, with no visible reset or panic cut. That progression signals a payout supported by recurring cash generation and a management mindset that treats the dividend as a standing commitment, not a flexible perk reserved for the easiest years. Step 1 passed, General Dynamics behaves like a genuine dividend eagle, with a resilient record of dividend growth that has held up across defense cycles and aerospace demand swings. Step 2. 5-pillar secret formula. First pillar, sales growth, the foundation. On a 10-year view, General Dynamics' revenue moved from roughly the low $30 billion range in the mid-2010s to about $51 billion most recently. The path is not perfectly linear. GD is influenced by contract awards and timing, program ramp schedules, defense budget priorities, and the natural cyclicality of business jet deliveries, but the long-term revenue base has expanded meaningfully. The durability across the cycle is the stress test. When procurement pauses or aerospace demand resets, revenue can soften. The key is that GD continues operating from a much larger base than a decade ago, supported by long-duration programs and installed fleet sustainment. Sales growth past, General Dynamics' expanding long-term revenue base supports the view of GD as a durable defense and aerospace platform with a credible foundation for dividend continuity. Second pillar, profit growth. The fuel, GD's profit trend generally held in the $5.6 billion to $7.0 billion range for much of the decade, with a notable dip to about $4.2 billion before rebounding to roughly $7.4 billion and then about $7.9 billion most recently. That pattern matters. It suggests GD is not reliant on one unusually strong year, but instead operates from a profit base that can reassert itself across changing program mix and execution variability. The driver is long program life cycles, disciplined bidding and execution, and the recurring nature of sustainment and modernization tied to installed fleets, not a temporary wave of demand. Profit growth past. General Dynamics' durable profit base strengthens dividend reliability and supports the case for continued dividend growth. Third pillar, net income, true strength. Net income starts around roughly $2.6 billion, rises into the $3.3 to $3.5 billion area in stronger years, and finishes near about $4.2 billion most recently, ending closer to the upper end of the decade's range rather than pointing toward deterioration. The pattern includes softer periods and rebounds, exactly what we want to see. A business that stays solidly profitable through defense and aerospace cycles without suffering a lasting earnings breakdown. Net income past, a resilient earnings profile across the decade, reinforces that GD's dividend growth is supported by real operating durability, not a temporary upswing. Fourth pillar, dividend payout safety, protecting passive income. For most of the period, General Dynamics' payout ratio stays in a comfortable band, generally moving from the low 30% area up into the low 40% range. There are fluctuations, but nothing that suggests the dividend has become detached from the company's underlying earning power. The ratio rises when profits soften and eases back when profitability normalizes. Exactly the behavior you want from a company exposed to program timing and aerospace delivery cycles. The dividend policy stays measured even when results are temporarily compressed. Dividend payout safety past. GD's payout ratio has remained within a sustainable range, supporting the view that the dividend is well covered under normal conditions and positioned to keep growing without unnecessary strain. Fifth pillar, debt burden, avoiding traps. General Dynamics uses debt, but the ratio spent much of the decade around the mid 0.6 to low 0.7 range before trending lower and ending closer to about 0.55 most recently. That picture suggests gradual de-risking rather than creeping stress. A balance sheet that has maintained room to fund operations and long-duration programs while keeping a shareholder return policy intact. Debt burden past. General Dynamics' leverage trend appears controlled and improving, supporting the view that the dividend has been backed by balance sheet discipline rather than financed at the expense of future flexibility. General Dynamics' overall financial score comes in at 98, very safe in our framework, signaling strong fundamentals and the kind of long-term resilience dividend investors want to see. Does it fit our plan? This is where we move from "is it a good company" to "what job should it have in my portfolio?" MaxRatio combines three signals: current dividend yield, dividend growth, and financial strength to classify stocks as growth eagles, balanced eagles, or income eagles. General Dynamics' MaxRatio is 3.66, which places it in the growth eagle bucket. With a dividend yield of 1.87%, GD is clearly not an income anchor today. The appeal is in its growth profile, approximately 37% cumulative dividend growth over 5 years, a payout ratio consistently in the low 30% to low 40% range, and 27 consecutive years of dividend increases that reflect a shareholder return culture built for the long run. In practice, General Dynamics is a compounder, a modest starting yield designed to grow steadily over time as long-duration defense programs convert into cash. Gulfstream deliveries expand the aftermarket base, and management keeps raising the payout in line with through-cycle earnings growth. It fits investors who want long-run dividend compounding from a high-quality defense and aerospace franchise and can accept the occasional program timing variability along the way. Is the stock undervalued today? Here the signals are mixed. Versus peers, GD screens as undervalued in the Max Dividends app, meaning the market currently assigns it a cheaper than average valuation relative to comparable defense and aerospace contractors, suggesting more earnings power per dollar invested than much of the sector. Versus its own history, the current PE is around 21.69 versus a 10-year average near 18.85, meaning investors are paying above GD's typical historical multiple, a less favorable setup than when the market offered the same fundamentals at a discount. On yield, GD pays about 1.87% today versus a long-term average near 2.16%, meaning the starting income is below what investors have typically received. The dividend keeps rising, but a strong share price has compressed the current yield. Analyst consensus sees meaningful upside, with an average 12-month price target implying roughly 16% upside and an overall lean toward buy, though the wide target range reflects real uncertainty around contract timing, program execution, and Gulfstream delivery cadence. Final decision. Taken together, General Dynamics looks like a high-quality dividend grower priced at a modest premium to its own history, with a yield slightly below its long-term norm. That can still work well if your goal is long-term compounding and you are comfortable prioritizing durability and rising payouts over maximizing current income. For dividend investors, GD makes the most sense as a growth eagle you accumulate with a long horizon, a 1.87% starting yield paired with 27 years of consecutive increases, and the potential for that payout to keep growing substantially over time as General Dynamics executes across its defense programs and Gulfstream cycles. The key watch item is valuation. When the multiple is already above its historical baseline, future returns depend more heavily on continued clean execution and sustained demand. Subscribe for more analysis. This is not investment advice.